So Betfair trading doesn't have to be difficult. There are plenty of strategies out there. Some are easier than others, and some trades seem pretty straightforward and simple. And sometimes it's obvious to me what the market is about to do, so much so that I can actually give people a little bit of warning about what is about to happen. This happens all of the time, but there was one trade that I did today that I thought was a particularly good example. So I thought, you know what, this would make for a good video to explain what my thought process was, how I was able to spot it beforehand, and how you can begin to look for these sort of things within the market. If you're interested in Betfair trading and you want to learn how to trade, then visit the Academy where you can do exactly that. If you want to talk to professional Betfair traders, then why not head over to our forum where you can talk to like-minded people, but you can also download additional content. And don't forget to head over to our website to download a copy of Betangel, the cutting-edge software that will completely transform your trading. So where this trade actually starts is with a tweet. And I do this occasionally, not all of the time. It depends how intense the trading session is. If there's lots of races, one after another, falling all over the place, I'm too busy actively trading it to be able to comment much on it. But every now and again, a nice little gap appears, a situation develops, and I'm pretty sure I know what's likely to happen next. So that is what happened on this particular occasion. What I actually did was I actually tweeted out, and I've included the typo that I made here as well, to indicate what I thought was likely to happen in the market. And basically what I'm saying is that, the price has come all the way in, it's seen very, very steady backing, and that I think that it's gone far enough. You'll also notice a hint of sarcasm here because this was about the third time that I've mentioned in this particular week that you won't see any steadier backing than this over the course of the week. So yeah, there was a little bit of a jokey element to it in terms of, here we go again. But the most important thing that you can take from this particular tweet was that I think that the price had gone far enough. So why did I actually think that that was the case? So if we look at the chart that I first spotted and that got my interest going in this market, the interesting thing about this is I know there will be people out there sort of saying, well, how did you know it was going to bounce? Because every time I do that, it just seems to plow on inwards. There are a couple of factors within that, but typically when you get small progressive inward movement within a chart, you tend to find it reaches a point of value at which people are no longer willing to back it. But you also find that, people may have traded it and they want to exit. So when the market begins to weaken, it tends to spring back in the other direction. So I'm looking for that lack of backing activity within the market that will prevent it from going any further. And you tend to find that when you get sort of slow progressive backing within a market, a bounce becomes more likely. If you're seeing large chunks of money thrown at the market and that are pulling the price in dramatically, that's a little bit harder to read. That slow progressive activity in the market eventually pushes the price to where it no longer becomes value, or where people, when they see weakening activity, begin to take out their trading positions. Now, I have done a video on this which explains it in a lot more depth, so I've sort of paraphrased it very neatly here, but I suggest you go off and watch that video because not only does it explain it in depth, it's quite an entertaining video as well. With a key, unlock the door to your imagination. Beyond it is another dimension. A dimension of sight, a dimension of sound, a dimension of mind. You're moving through a land of both shadows and substance, of things and ideas. You have just crossed over to the FOMO zone. So make sure you check out that video because the detail you need in terms of what I was seeing within the market is contained within that video. But typically what I'm, to summarize it, I'm seeing a trend that's about to sort of die effectively, and therefore pressure will build for it to go back in the other direction. But the other thing that I saw within this market was that it was approaching a crossover point. So if we had, as we approach the crossover point, there's always a tendency for me to prefer to lay. And that is because the trade gets stacked more in my favor. At odds of 2, if I can lay at odds of 2 and expect the price to drift, then my potential payoff against the risk that I'm taking is about 2 to 1 in my favor. Again, if you want to learn more about crossover points, the detail behind them, why they're critically important points why you should be looking to lay at those particular points within the market and where the name crossover came from, I've produced a video specifically for that. And you can examine that in a lot more depth and get a key understanding of that. But yeah, I suggest you go off and watch that particular video. And that is to indicate that you're approaching a crossover point. And the key facts to know about crossover points is that as the price rises above it, but essentially what we had here were two key factors. You know, we had a setup that we felt was familiar, it was near a crossover point, so we knew needed to lay. So then we were going to confirm it with a little bit of activity on the ladder. We were looking for an accumulation of money at a certain price point, we were looking for the backing to start weakening, and that would be the point at which we would enter that particular point within the market. Now, inside my head, I have an internal scorecard where I can sort of see a 10 out of 10 trade or variance and grades thereof. And I have mentioned in other videos that I raise and lower my stakes according to how confident I am with what's going on actually within the market. So, you know, this had some nice factors to it, which is why I felt confident enough to tweet about it, because I felt it was almost certainly going to happen. But when you're actively learning to trade, one thing that I recommend is you don't go into the market and try and assess what's happening within the market, because that's quite a hard skill to develop. I've developed it over a large number of years, and having traded hundreds of thousand markets, I've seen every type of market you could ever possibly imagine. But what you should be doing when you're learning to trade is settling on a strategy, a style, and then you start looking for that within the market itself. One of the issues that you will have is that to start with, you'll be a little bit behind the curve, that you'll spot the moves after they've happened. But over time, and with a bit of experience, you can begin to get better and better at that. And you can get quicker and quicker at spotting those opportunities. And then eventually you'll cross that line where you begin to anticipate them. And where I am within the market is I can anticipate what's likely to happen next because I've seen it so many times. I look at the market, I think, oh, this is interesting. I've seen this sort of pattern before. I think I recognize what is likely to happen here. Then I look for confirming factors and then I'll actively trade it. But when you're starting out, attempting to do that is quite hard. So my recommendation for you is, like, if you want to look for these types of trades, you will see them within the market, but they're not going to occur in every single market. And they may not even occur over the course of a whole day. But by sticking to a particular strategy and waiting for that opportunity to occur, you will definitely find some and you will definitely get them right. But essentially what you're trying to do in your head is you're trying to say, how confident am I that I recognize what I'm seeing here? Is it doing what I expect? And if you score quite highly on your internal scorecard, then you can proceed. But if you don't, then you basically just wouldn't do anything, because you're not going to lose any money if you don't actively trade, and you can just wait for the next opportunity to come along, which may actually be even better than the one that you're looking at this particular moment in time. So when we look at the final position of the trade, you can actually see that I netted just over £200. But you can also see the stakes that I was using, £2,000. Who on earth uses £2,000? And I can't use £2,000. I don't have the same bank as you, Peter, all of that sort of stuff. Well, no, don't worry about that. It's if you know how I trade and you know how to trade properly and you're managing your risk within the market, you shouldn't freak out when you start seeing larger amounts. Because when you're actively trading, you're taking a stake, you're putting it in the market, you're taking it out, and you're going to make a bit of money, hopefully, on your exposure for the time that you're in the market. You should never put that stake at risk at any point. Because we're trading pre-off horse racing here, what we're doing is we're putting the money in the market for a period of time, then we're taking the money back out before the horses are loaded, before the race goes in play. So we're just basically putting the money in, taking the money out, and we're going to make a percentage of that particular stake. But of course, it's still quite a big stake here. £2,000, not everybody has access to that. Well, you don't need that, because if you've watched any of my other videos, you will know that I tend to break up trades into smaller amounts. And we had a £200 profit before the offer, or roughly fully hedged, that turned into about £100. But if we actually look at the individual stakes that we were using when we're active and in the market, you can actually see that they're broken down into chunks of 500. So whenever I'm actively trading, I'm feeding orders in, I'm feeding orders out, and I'm managing my risk that way. So it's not a case of me taking £2,000 and dumping it in the market. I'm always, as I've just mentioned, easing the trade in, easing the trade out, and managing my risk that way. So there may have been some point within this market where I had exposure above £500 or so. But ultimately, that the risk you're taking is just a percentage of the stake, and necessarily you're feeding orders in and out of the market. And you can reduce your risk by using a smaller stake, but repeating the trade more than once. So yeah, you could look at it in two different ways. You could say that I earned 10% of my total staking, or you could actually say that I earned, £100 on a £500 individual stake, which sounds more impressive. It's up to you how you want to represent that. But I never feel under pressure when I'm staking within the market, because I always know that I've got a defined plan of when I'm going to get in, when I'm going to get out, when I'm going to hedge the position, and therefore that stake never feels at risk to me at any particular point. So yeah, if we look at this trade, you can see that we had a reasonable return, whichever way you measure the stake. But typically, you wouldn't be looking at those larger amounts and assuming that that was exactly what the stake that I was using. That was just the amount that we managed to trade through this market. So to summarize here, we sort of used two key sort of themes that we have seen in other videos. We were looking at people consistently backing, and other people were following the trend, and the price was coming in, but we arrived in the market too late to be able to pick up on that trend and jump on the back of it. So we chose to do the opposite thing, which was we knew all of that money had been into the market. It was inevitable. Well, I say inevitable, nothing's inevitable. It was very likely that the price wouldn't continue like that forever. It would actually turn and bounce at some point as people began to cash out, or the favorite began to get less value. And we took advantage of that. And one of the reasons that we took advantage of that was because it was near a crossover point. And by being near a crossover point, it meant that the risk-reward ratio was heavily stacked in our favor. Even if the price went through our entry point and started to head off in the opposite direction, it would buy us more time and create less loss than if the price headed up in the other direction. So we actually had a number of key factors in here, including the commentary from the race course, the amount of time left in the market, and so on, that was stacked in our favor on this particular trade. And that gave me the confidence to actually go out and state what I thought was going to happen before it actually happened. If you want to replicate this trade, then what you need to do is look for similar scenarios within the market. It's occurred several times this week. It will occur next week and the week after. But like I've said to you at the beginning of the video, if you're just starting out trading, then your role as a trader really is to focus on one particular opportunity and then try and find that and become good at it. And initially you probably won't be that good at it. But if you practice it as much as I have, then it becomes almost second nature. You can turn up to market, you can look at it, you can see several scenarios unfolding, and you can decide what run you're going to trade, when and why. But yeah, that was a trade that I did this week. I thought it was a relatively straightforward trade, nothing ambitious or uninteresting in there, but it also included several elements that we've covered in previous videos. So anyhow, I hope that video was useful for you.